Today we're going to talk about major purchases that a household might make and that you would probably have to deal with as a financial advisor. Specifically, the two largest assets that we tend to acquire, at least in this country, are houses and automobiles. In fact, a house for most families represents the largest part of their portfolio. In retirement you could downsize your house when your family has left, your kids have left the home. You could downsize and sell it, and then it becomes almost like an investment. Automobiles, they're a little bit more less of an investment unless you're dealing in classic cars, but they're depreciating assets, whereas homes tend to be more appreciating assets, correct? So the whole lecture today focuses on these two very important decisions, and decisions that could either make or break a family financially. In terms of learning goals, you could read them here. Design a plan to research and select new or used automobiles, deciding whether to lease a car, to buy a car, identifying housing alternatives, rent versus buy, that discussion, that type of analysis. The benefits and cost of home ownership. Are there really any benefits? Is it still the American dream? And the process of buying a home and how to choose the right mortgage for you. So, we're going to first start by talking about buying an automobile. Technology has made it so the traditional way of going to the dealership and being heavily dependent on the salesman for a deal is no longer is somewhat antiquated. Now we have technology, we have apps like TrueCar that goes out and does the research for us to enhance the purchasing aspect of the sale, right? The car that we need. You want to select things that you need. For example, if you're gonna be in a winter area, you might not want a BMW 3 Series. You might want the SUV version. Or if you're gonna be doing terrain, you might want a four-wheel drive. But what the technology also does, again, sites like TrueCar and apps like TrueCar, allows us to negotiate price. We no longer are price takers when it comes to this. We could be price we could force our own price. We could try to establish our own price, our own value that we want to achieve. And then it's good that we understand the terms of the sale before we purchase. Okay, are we buying the vehicle? Are we leasing the vehicle? If we're leasing the vehicle, how many miles can you drive a year? If you're buying a vehicle, do you have any limitations? Do you need to have gap insurance? And all these different considerations. And then we need to focus on the maintenance and repair. The true cost of car ownership isn't the sale, it's what happens after the sale, how much fuel, the maintenance costs, etc. So some of you that want those luxury cars, focus on maintenance. And maintenance is extremely, extremely expensive, as opposed to some traditional middle market brands. So what are some factors to consider? Obviously, affordability. Can you afford the monthly payments? So you want to make sure that you're not spending way too much on your car. Your car should not be priced at the same rate as your home. What's the operating cost? How much is it going to cost on gas? How much is it going to cost on oil? How often do you have to change that oil? Right? How often do you have to change the other fuels? How often do you have to get it maintained? What size is the right size for your body? If you're a bigger set guy like myself, you might need at least a full size car and not something that's a little bit smaller like a Fiat, right? Is the body style appropriate? What about the color? What features do you want? Do you want navigation or safety features like lane keep tracking, lane keep assist and park assist and these types of features? So you have to choose the car that you want, and maybe even more so the car that you need. Um, Other things to consider: what's the potential trade-in value if you're gonna sell your car? Right, to purchase this new car, you're trading in an existing car. Well, what's the price that you're gonna get on that one? All right, some dealerships will probably offer some sort of deal to entice you to come in, so you want to be extremely, extremely, extremely careful because you know not all when something seems too good, it might just be that. Okay, and we talked a little bit about the safety features. The Obama administration made put in some legislation in place to make cars a lot more fuel efficient. And you would see now cars are getting 34, 35, up to 40 miles an hour. So that might mean more to you, right? And then we have electric cars like the Tesla, the Cruise, um, the smart car that's pictured here, right? But then we cannot forget about insurance, the cost to insure the car. Insurance is mandatory. We all have to have insurance. Even more so, before you leave the dealership, you have to have insurance. If you're going to buy a car, new or used, you're going to have to have insurance, especially if you're going to finance that purchase. So, the transaction itself, right? The price that we see is a manufacturer's suggested retail price usually. When you hear sticker price, that's like dealer's cost. Yes, the dealer actually has a cost. When you're closing the deal, sites like TrueCar will give you the average price of similar cars sold in your immediate area. Well, that's something that you could go and argue for. Well, this dealership across here sold a car for X. This dealership is selling a car for Y. And you then now have negotiating power. You could drive that price down. Focus on negotiating the price. The first question they tend to ask you though, how much do you want to pay monthly? You go from time value of money. If you give somebody a payment and they're trying to finance you and they know your future value would be zero, your present value would be the price of the car, you already give them your payment, what can they find? Right? Most cars are now being purchased over 6 years. They already know your end. So what's left? Interest. They could know how much interest to charge you. So never tell them how much you're willing to pay. Ask them for the price of the vehicle. Leasing a car is very different than purchasing. Now, leasing traditionally, as long as you have no negative equity on your trade, has a lower monthly payment. So I'm sure you see it online. You could package it however you want it. You could have low mileage leases, which is what we usually see advertising on TV. Get the BMW for $299. Well, that probably means you're driving only 8,000 miles a year. Or get the BMW, get a brand new car for $199 or $99 a month. Same thing, very low mileage leases. But even in higher mileage, 15,000, which tends to be average, leasing tends to be a little bit more cheaper because you only have the car for a specified amount of time, and when you trade it in, it has a specified predetermined value. So more expensive car for the same payment you may have. So for a $600 payment on a Toyota Camry, you could probably have two leased BMWs for that same price, depending on your credit score, depending on the miles drawn. The down payment could be lower, but a lot of companies require at least 25 to 3,000 down. It might not be that efficient in terms of that great of a lower down payment. You could purchase a car with zero down. On average, each $1,000 that you put down, you save around $15 to $20 in monthly payment. So that's something to consider. When leasing a car, you pay for its use during a specified time period. At the end of the lease, you don't owe anything. You could walk away, or you could get a brand new lease. The process, we have two different types. We have closed end and we have open end. Closed end is the walk away from the car when the lease is over. That's the most popular, clearly, because you have no debt, you have no tie to that vehicle. The open end payments are based on car's residual value. So upon return, you're gonna pay the difference if the car is worth less than estimated, right? So you have a closed end lease and an open end lease. You always want to try to get a closed end lease so you could just walk away. And because you walk away, chances are you're gonna have a slightly higher payment on closed end lease as opposed to open end lease because the dealership will be taking a lot more of the risk. How do we calculate it? How do you calculate the lease that we're gonna pay? Well, first the terms. What's the lease terms? How many years? How many miles? What's the forecasted residual value at the end of the lease? How much will the car actually be worth? What's the price of the car in terms of leasing? The language is capitalized cost of the car. It's the same as price. What's the price of the car? And what's the money factor? What's that financing rate that you're gonna get on a lease? Yes, even though you're leasing with at borrowed money, right? It's somebody has to pay for the car. The car is gonna be paid up front, and there's a specific interest rate that you'll be charged, which is a function of your credit score. Right. So if you read the fine print on some of those TV ads, they're trying to get at the, this deal is only for people with 800 credit scores or something to that effect. So when we're deciding whether or not to lease our purchase, it sounds like a simple decision. Is it really? It could be. If you want to hold the vehicle for a long period of time, 6, 7, 8, 9 years, purchase your vehicle. You're gonna get the use out of it. And you actually might get some disposable income at the end of this if you sell it back. If you're one of those types of people that trade their cars as often as we trade our cell phones, then maybe leasing is the best option for you. Okay. So, and if you decide on you're gonna lease, you decide when you return the car, what do you want to do? You want to put the difference, maybe buy out the car, or do you want to just walk away? All right. Let's talk about housing for a little bit. Talk about housing. A home in this country has been tied and referred to as the American dream. In this country, home ownership used to be that thing that all Americans sought to do, but now we have a whole group of millennials that are saying, hey, this is not for me. I don't want to own a home. I want to have wealth, right? I rather rent and then grow my money. I remember we talked about if President Trump tax changes get into effect, then I think there might be a negative impact on home ownership because right now the taxes support home ownership through itemized deductions. You remember that from our tax chapter. So how do you decide if we're going to buy or rent? So for the next few pages, we're going to go through different types of houses and different considerations for each. We're probably going to go through a small, simple buy or rent analysis. Okay. So single family homes are the most popular types. As I said in the beginning, it represents a significant portion of the overall portfolio for most households. It offers more privacy. You get more property control. You could mow your lawn. You could paint it whatever color you want to. You don't have to have anybody telling you exactly how to live and where to live and what to do on your property. Well, unless you have a homeowners association. Okay. We have condos. Now, a condo. You've heard if you go to South Padre, those are all condos for the most part. It's a form of ownership. It's like owning an apartment, owning a townhouse. You have title to a unit, right? And you jointly share common areas like sitting areas, the pool with everybody else that also owns a unit. There tends to be a homeowners association fee, a monthly homeowners fee in addition to your mortgage payment. So you want to be cognizant of what that is and make that a part of your calculations if you're going to live in a condo. There's also a special type of homeowners insurance for a condo. So if you're going to live in a condo, you're not going to have the same type of insurance, homeowners insurance, as you will if you're living in a single family home. Right? It's going to be different. Co-ops. I don't think they're very popular in the valley here, but they might be popular in bigger cities. I know that there are a number of them in New York, there are a number of them in Atlanta. Tenants own shares in a non-profit corporation that owns a building, a co-op. So you lease units from the corporation. So you're a shareholder of this non-profit that goes out and buy real estate. Okay? You lease the units from the corporation. You assess fees based on the space that you're occupying. So, for example, if the total space of the building is, let's say, 100,000 square feet, and you only occupy 1,000 square feet, then you'll be responsible for 1% of those fees or costs of that firm, of that space. So that's service, that's maintenance, that's the property taxes, that might be the mortgage. So it's a shared cost, all right? So you form a nonprofit, the nonprofit gets different people to come and you put money together and you buy that property, right? Rental units. Now, who should rent? And most of you are probably renters. You probably have your own apartment. You're probably very familiar with this. If you don't have a down payment for a home, you're not sure if you want to stay in the area, you're not sure if you're ready for the commitment of home ownership, if you don't want the responsibilities like cutting the grass and having to fix things when they break. You're not sure if you're gonna move within the next few years. There's nothing wrong with renting in that regard. And like a condo, it's gonna have a different type of insurance. You're gonna have different types of insurance, like renter's insurance. I'm alluding to this now because we're gonna talk more about insurance in the last unit in the class. But rental units aren't bad. When I first moved here, I rented. I rented and then I bought a home mainly for the tax shelter, right? And homes were very cheap in this area. So having gone out, I bought a single family home, and I could tell you, I wish I didn't, because I wasn't ready for the responsibilities of home ownership. So, when it comes to the rental option, and just to understand the terms of the contracts that you're signing, a lot of people don't really understand the terms. I have friends that have been in a really bad situation with rental contracts. The lessor, that's the owner of the property, the landlord, you're the leasee, you're the one who leases it. Now it specifies your monthly rent and due date in Texas. I think rent is usually due around the first. You have up until the fifth, penalty free. After that, penalties will be assessed. Your length of your lease agreement, typically 12 months. You could get 6 to 9 months maybe for a premium on the rent. You could go up to 15, 18, something like that. Deposit requirements. They want to make sure usually your first and last month's rent. Make sure you could pay right now, as well as they want to hold that last month's rent in the case that you have any sort of maintenance problems. Do you renew? Do you renew at a discount? Do you renew at a higher price? You have to know your rights before you sign your lease. And unfortunately, a lot of people don't know their rights before they go and sign a lease. And they might sign a lease that's very costly. Which brings me to a rent versus buy analysis. You may have clients that come into your office and say, hey, I want to rent, but I'm also interested in buying. And I want to be able to determine what's the best option for me. Well, this is the process that you'll take them through. Okay, a rent versus buy analysis. There's a calculator that is run by the New York Times. They have a rent versus buy analysis, the New York Times, and it's really, really good. And you could look at it, but if not, you could follow this worksheet. What's the cost of renting? Obviously, a year of worth of rent. So your monthly rent listed here, your annual rent insurance as well, and the opportunity cost, that $1,000 that you put down, after tax savings rate, and that will give us the total renting cost. Okay, here, 10,840. Now let's contrast that to buying. We'll look at the terms. We have a $120,000 house over 30 years and at a 6-month interest rate. That means our monthly mortgage is $7,719, just based on these rough calculations. Okay, so that gives us a mortgage of 8634. Now we also have property taxes, and in Texas they're extremely high. So we're gonna look at 2% of the value of the home, right? 2% of the 2% of the price of the home. The price of the home is here, $120,000. Then we have home owner's insurance, which is separate, right? Then we have the maintenance, which maintenance would be, and if you're buying a brand new home, this probably won't be that much of an issue. But in a typical older home, you may have to maintain it annually, so you want to put some money aside just to do that. After tax costs of interest on down payment and closing cost, right? So we have a situation where we put after tax cost of interest on down payments, put down 34.5, which was 20%. So the cost of the home was a little bit higher than the 120 because that's the terms that the borrowed amount. We probably put down 20% thereabout at a 4% after tax rate of return, adjusting for inflation. And then what we'll get is the total cost. So we have a total cost of around 14,000 versus a total cost on renting of 10,000. But it doesn't stop there. Okay, so what does that mean? Well, You have to then take away from that 14,000 the principal reduction in the loan balance every year. You're going to save a little bit on principal once you make some money, right? Tax savings due to the interest rate deduction, $1,800, $7,200 in mortgage payments, and at a marginal tax rate of 25%. That's how we're going to come to that conclusion. Then we have tax savings on property taxes. Again, the property taxes we paid were 3,000. We're going to save 750. Total deductions, you're going to sum them up, subtracted from the total cost of home ownership and estimated annual appreciation and value of a home. So it's a appreciating asset, so you get that to you, and that really brings the true cost of home ownership down to 7,980. Compare that to the 10,000. You could see in this case, in this example, at that price point of rent is actually cheaper to buy a home of around $150,000. And this analysis would be even better if we could get a lower interest rate and a lower maintenance cost overall. So the benefits of home ownership, just that. We just saw the tax shelter benefits. It's an inflation hedge because annually property values should rise at the same rate of inflation. And your satisfaction, it's yours. You walk in, you look around, it's yours. You own it. No one can tell you to move. No one can tell you to move out. It's your home. But the cost of it, as we just saw, we have down payments, we have points and closing costs, mortgage payments, property taxes and insurance, and maintenance and operating. So it is costly. Now, when you put money down, the amount of money you put down relative to the total cost of the home is your down payment. Okay, so let's assume that you have a home you're purchasing. You typically could put down, according to the book, 5 to 20%. Actually, you could go and government has some programs where you could put down as little as 3.5%. Or if you're living in a very undeveloped area, you could get USDA loans and have actually probably have a 0% down payment. So it really depends. But once it's lower than 20%, you're gonna have to have what is called private mortgage insurance. Even if you're with a government program like the FHA or the USDA, if you don't put down 20%, they're gonna charge you an extra fee monthly to offset the risk of potential default. So now the loan to value ratio is how much you borrow versus the cost. So let's assume $150,000 home, you put 20% down, so that's $30,000. You borrow only 120, so your loan to value ratio would be 80%, right? Loan to value, loan to value. How much loan do you borrow versus the value of the loan? Uh, Points is a very interesting phenomenon. People somewhat get confused about what points really are. But points, you're buying a discount, right? It's a premium paid to lower your mortgage rate. So let's look at the buy, sell, buy versus rent discussion earlier. They had an interest of 6%. Well, 1 point represents 1%, and you'll pay it at closing costs, right? So you could buy down, so it's going to be 1% of the home of the loan value, and you could buy that down. Okay. It's a one-time fee charge that increases the effective rate of interest. You could go from 0 to 3 points assessed on your mortgage. The longer you go, the more you points you might have as an opportunity. But it's also deductible because remember we could deduct mortgage interest. Okay, so 1 point is equal to 1% of your loan amount. And we have these ridiculous closing costs if you've ever experienced them. Yes, you have to pay all of that close on your loan. Right? There's a loan application, there's a loan origination fee. You have to go and pay a title. There's some attorney fees. You have to get your property appraised. They charge you for pulling your credit report, any inspections, any surveys, filing fees, and all this is going to be paid out when you're closing on your property at the title company. Okay. You could follow this chart just for an example of what that looks like. Size of down payment versus the difference. So the lower your down payment, the higher your closing costs. You can tell. Lower your down payment, the higher your closing costs. And the difference really stems from the points, right? And not all mortgages comes with points. You might not have the option to buy down points, but it's there as an option, and you could actually save in the long run, not necessarily in the short run, because your upfront cash flow would be a little bit higher. But these are examples of what all goes into that closing cost. And you could see the difference here focuses more on the loan origination fee and the actual points that you are charged, as well as the mortgage tax. So clearly the tax will be different, right? Because the amount of the loan is different, the amount of the mortgage is different. So this takes me to a discussion that those of us who own homes will be familiar with. PITI, principal, interest, taxes, and insurance. When people think of a mortgage, sometimes they ignore the TI, the taxes and insurance, and that's a very important part of it, right? So PITI, principal, interest, taxes, and insurance. The principal and interest that goes to the lender to repay a mortgage, the taxes and insurance are held in an escrow account. And the escrow account is they basically want to gather this money for you over time, and then this escrow company will go and pay your taxes to the county, whichever county you may live in, on your behalf, and they'll also pay your insurance. And it's a little form of protection for yourself, but as well as for the company at the same time. Um, if you think back to our discussion on ratios and the different housing ratios, well, here you're seeing them again. Okay, you want to have the affordability. The lender is going to determine how much you could actually afford to repay, how much house you could afford based on your income, right, and based on your expenses. So you want to make sure that your expenses are very, very, very tight. No, this is less than, look, for example, total volume monthly installment loans less than 33 to 38% of monthly gross income. Well, now they're going up to 58% of monthly gross income on the overall payment. So we have to be a little bit more cognizant of that, because that affects the interest rate that they actually charge us overall. So here's an example of how we calculate this. And the colors aren't great, so apologize that green might be a little bit blinding. If your monthly gross income is $4,500, what would your maximum monthly mortgage payment be if the lender's affordability ratio stipulate that your mortgage payment not exceed 25%, nor your total installments payments exceed 33% of your monthly gross income? Think about that. What is the maximum monthly mortgage? How much mortgage can you actually afford? Well, to get the answer, that one is easy, right? You look at 4,500 times 25%, should not exceed 1125. This is PITI. Your total installments payment should not exceed 1485. Okay, that's how much mortgage you could afford. Here we see a $10,000 loan. What you will notice is the higher the interest rate, the more we pay, the longer the term, the less we pay. Higher the interest rate, the more you pay, the longer the time, the less you pay. The higher the interest rate, the more of this loan payment will actually go towards interest, and the remainder going towards principal. And then the longer number of years we have, typically we have mortgages around 30 years and 15 years. You can see the difference. It's almost a 33% difference. So at 30 years, which is typical, that's 360 payments over time. And people tend not, I don't think people nowadays stay in their homes for that long. They buy, they sell, they move. But still, people go through the home buying experience just because. Back a little bit more on the taxes and insurance. We explained the escrow process already. But each month the lender will collect 1/12 of what this costs. So if your property taxes are let's say $4,800, every month they're gonna take $400 for property insurance. Assume your property taxes. Sorry. Assume your insurance is $600 a month. every month they're going to take $50 away. So you could pay them directly, but again, this gives you some protection, and things happen and you might forget. This is what I mean by other maintenance expenses and stuff. Lawn maintenance is very expensive. On average, you could pay up to 60, 70, $80 a month. It doesn't seem like a lot, but that could be up to like $1,000 a year. And when you have change in seasons, they're gonna want to do this, that, and blah to your lawn and cutting your hedges and grooming. It could get really pricey. And then we have utilities. You have to probably have stuff outside and all of that. So painting, repairs to the building. It could get really costly really fast. All right, so let's shift our discussion a little bit more towards different type of real estate transactions and different ways in which you could actually go out and purchase a home. Uh, After 2008, they had tons of foreclosed properties. And in the Valley, we had more foreclosed properties than the entire state of Texas. So the short sale is one of those processes that you could use to buy a home. Now, in a short sale, the proceeds of the sale are less than the balance owed to the mortgage, and hence the word short sale. The bank might have repossessed the home and they just want to get paid, right? They just want to go and get some money out of it. The builder is already paid, the homeowner that you bought from is already paid. Now the bank wants to get their cut, so they may offer what is called a short sale. Then we have the foreclosure, where the borrower cannot make the payments, so the lender repossesses the property. We had a lot of that here in the Rio Grande Valley after the 2008 financial crisis. Okay, now if you're gonna buy a home or you sell a home, you tend to use a real estate agent. And most realtors they have to go and belong to the multiple listing service. It basically gives a consolidation of all the properties in the area that are being sold or up for sale. Agents usually employed by a seller and are paid a commission if they make the sale. Typical commission could be 5 to 6%. In my experience, I'm going through this right now, and the guy charged me 5%. He's listed on the MLS. He put the house up. He advertises. He markets on my behalf. He has open homes, open houses to show off the home and stuff like that. But yeah, but you could sell it on your own. I bought my house on my own. I didn't use an agent, but you could also use an agent to purchase as well. But I did it on my own. I bought directly from a builder. Now, if I was probably going into a more secondary market, it wasn't new construction, I may have used a realtor to sort of filter through a lot of the inventory on the market. But yes, agents usually employed by a seller, but they could also be employed by buyers as well. What's the process? You apply. Apply for the loan, see if you're pre-qualified, get a pre-approval. You find a house you like, you enter into a contract. You provide the earnest money, right? It's out of a deposit. Say, okay, you know what? I'm gonna use this. I'm like this. I'm gonna lock it in. And then there's a contingency clause. You have to do certain things by a certain time. All right. And then you close the deal. The government has put some stuff in place to protect us. The Real Estate Settlement Procedures Act. You have to check the title, ensure the title is clear. You don't want any liens on the property. For example, maybe that person you're buying the home from haven't paid property taxes in a number of years, or you don't want to have that problem. So that's why it's good to work with a title company so they could do all this analysis for us. Closing statement provides details of the costs for both you and the seller. You get that. That's integral to actually calculating your taxes in the next tax year. And obviously, we know where we get the money from, but who do you borrow from? You're borrowing from your future self via these institutions. Commercial banks have banks just specifically for mortgage, and they have mortgage brokers that could help us in securing mortgages from potential different lenders. You could also go online. You could check online, Quicken and Lending Tree and these types of sites that go out and they actually find suitable mortgages for you based on your current financial profile. We talked briefly about this. I won't go much further into it. You can see the difference between the 30 and the 15-year note. They see the difference that you're paying interest as well. Instead, I tend to recommend you take the 30-year where you can make an extra payment if you could afford it. That way, you're not tied into the 15-year commitment, which is at a higher price. Because cash flow is important. Yes, you buy a home, but cash flow is really, really, really important. Another thing to understand is that your taxes could go up or down. Your insurance prices can go up or down. The fixed part of your mortgage payment is just the principal and interest. That part is fixed. So if you see any change in your overall monthly payment, it's probably due to taxes and insurance. Okay. Now we have two different types of mortgages that we could choose from. We've talked about the fixed. Now the adjustable rate mortgage is the option, the other option. So 2008 partly happened, the financial crisis, because of adjustable rate mortgages. It's the rational actual mortgage. When the economy is doing great, you pay a little bit more because you should be better off. You should be getting higher wages. Economy is not doing great, you pay a little less, right? And so on. So, oh, well, that's actually vice versa. The economy is not that great. Interest rates gonna go up. Economy is doing good. Interest rates might be flat. Whichever perspective. Regardless, it's the same concept here. And it has a period that adjusts, it has a interest rate that adjusts, but it could be negative. It could cause a negative amortization schedule for you. Right? But there are payment caps and they tend to be interest rate caps. It might start at 3%, but it cannot be more than 8%, or it cannot be more than 11. But this is what happened in 2008. Mortgage rates kept going up, and people could afford less and less of the payments. So they went underwater. Yeah. But what is negative amortization? So typically, if your loan payment is lower than your monthly interest charge, then the principal balance will increase. If the monthly loan payment is lower than the monthly interest charge, then the principal balance will increase. And this could result in a larger mortgage balance on the next loan anniversary, right? So what that means is if your monthly loan payment that you're paying because of these fluctuations in adjustable rates is lower than the monthly interest charged, right? So let's say the monthly interest charge, because we have an adjustable rate mortgage that went all the way up to 8%, our total payment here is, let's say, 800, but the interest is now 850. Then that $50 difference might be added to your principal, and it could be at an escalating scale. So that's what a negative amortization means. Okay. You can have a convertible arm, allows borrowers to convert to a fixed rate at a later date, or you can have a two-step arm, have two initial interest rates, lower one for the first 5 to 7 years and a higher one for the remaining period. Okay. Other payment options, you could only pay the interest. You could do a graduated payment. You could do bi-weekly mortgages, will actually help when it comes to the overall interest that you pay. You could buy down the mortgage. You could do a large lump sum if you're coming to some new money. You could put a large lump sum instead of probably having it in cash, right? Sitting in your bank, you take a lump sum, you put it down, and then now you have equity to asset exchange in that regard. Interest only, more deductions on your taxes. So it really depends on what that client is trying to accomplish as well. Well, we have different types of loans. You have the conventional loan. You, as the lender, assumes all of the risk. There's no collateral except for the home itself. Usually requires 20% down, but not typically, because as I mentioned earlier, there are a lot of programs to help with that. If it's lower than 20%, though, we will have that PMI that we discussed earlier. And they have the FHA, which I mentioned. It's put on by HUD, and you give offers lower down payments and interest rates and closing costs to average Americans. You only need like a 580 credit score to qualify for an FHA mortgage. If you're a veteran, well, there's a mortgage option for that. I had a friend that just used this veterans option not too long ago. Payments guaranteed by Veterans Administration, a one-time loan, and without any down payment. Okay. Now, there might come a time when, let's say you got a mortgage and that mortgage was at a 6% in the example that we saw for the rent versus buy analysis. Interest rates have fallen. It's rational to want to refinance, right? You want to make sure you're getting a better rate. Maybe you could lower your monthly payments, but it might not be worth it. You want to make sure of some different things, right? So, now, although the new lower rate can reduce your monthly payment, it can reduce the total borrowing costs. You might actually not be for you. One, you have to pay closing costs on the new loan. So if you're going to pay closing costs on your loan, reflect back on that. It could be up to 2% of that amount that you're borrowing. And guess what? It might not be that much more beneficial. The $50 you're going to save versus the $5,000, $6,000. How many years will it take for you that you have to remain in the home for you to even break even? So you have to be cognizant of that. Now, there's some new loans out there advertising saying, well, you won't have to pay closing costs on refinance. I would just caution you to be very careful with those types of lenders because there might be another hidden cost somewhere else. Okay, and that's the analysis. You could take a minute and look through that on your own. But it's like the example I said. You had 8%, now we went down to a 5%, and you could change different terms.